Hi everyone. Welcome to our strategic review of the ORLEN Group. I am an analyst with HDIN Research. Today, we will examine ORLEN's performance through the lens of its 2024 financial results and its updated roadmap toward 2035. Our focus is on how the largest multi-utility group in Central and Eastern Europe is managing the transition from legacy fossil fuels to a diversified, low-emission energy ecosystem. Starting with the executive summary. In 2024, ORLEN maintained its leadership position despite significant market volatility. The group generated 295 billion Polish zlotys in revenue, with an EBITDA of nearly 36 billion. A key takeaway here is the financial stability, indicated by a net debt-to-EBITDA ratio of just 0.3x, which provides the necessary buffer to fund a record 32.4 billion Polish zlotys in capital expenditures for green growth. ORLEN's business model is evolving into an integrated ecosystem. While the legacy downstream and upstream segments remain the primary cash engines, the growth trajectory is shifting toward energy and retail. The strategy aims for 12 billion cubic meters of gas production and over 12 gigawatts of renewable capacity by the next decade, ensuring vertical integration from source to consumer. Under Pillar 1, the objective is legacy value maximization. ORLEN continues to optimize its refining and gas assets following the integration of PGNiG and Lotos. By maintaining operational efficiency and supply security, these segments provide the stable cash flow required to subsidize more capital-intensive renewable projects. Renewables are the core of ORLEN's growth story. From a baseline of 1.4 gigawatts in 2024, the goal is to reach nearly 13 gigawatts by 2035. Significant milestones include the Baltic Power offshore wind project, which remains on track for 2026, alongside a growing portfolio of solar and onshore wind acquisitions. However, the transition is not without complications. In 2024, we observed price normalization in the energy markets and rising costs associated with the EU ETS. Additionally, global oversupply in petrochemicals led to significant impairments. These factors emphasize the need for the pragmatic strategic pivot we are seeing today. Looking closer at refining, ORLEN operates a highly competitive asset map with over 45 million tons of total capacity. Despite global demand fluctuations, the group maintains a dominant 35% market share in Poland. The focus here remains on margin protection and technical reliability. In petrochemicals, the strategy has shifted from sheer volume to high-margin products. The suspension of the Olefins 3 project in its original scope demonstrates a disciplined approach to capital management. The new Chemia focus prioritizes circular economy products and renewable feedstocks. The retail segment is becoming a modern service platform. With over 3,500 stations across multiple European markets, ORLEN is leveraging non-fuel revenue levers such as the Stop Cafe brand and the VITAY loyalty app, which now boasts over 4 million active users. Decarbonization is no longer optional. ORLEN has committed to a 25% reduction in absolute emissions by 2035 and full net zero status by 2050. This involves a comprehensive phase-out of coal in electricity and heating, replaced by low-carbon alternatives like CCUS and biofuels. Capital discipline is central to the 2035 roadmap. ORLEN plans to allocate up to 143 billion Polish zlotys toward green growth. Notably, the group uses differential hurdle rates, ranging from 7% for green innovation to 12% for traditional value maximization, to guide investment toward low-emission projects. Reviewing the 2024 financial ratios, we see a decline in net profit, which was heavily impacted by one-time strategic impairments. However, operating cash flow remained robust at 36.6 billion Polish zlotys. The balance sheet remains healthy, with ROACE at 11.3%. Indicating efficient capital utilization. ORLEN maintains strong investment-grade ratings from Fitch and Moody's. The group's funding mix is well diversified between green bonds, GMTN programs, and investment loans from the EIB. With 39 billion Polish zlotys in undrawn facilities, the liquidity position is exceptionally strong. The upstream segment provides regional energy security. Norway has emerged as the strategic pillar for gas production. Following recent acquisitions, daily output has exceeded 100,000 barrels of oil equivalent, securing a diversified supply chain for the CEE region. In the gas market, ORLEN's dominance is underpinned by its 213,000-kilometer distribution network and 7.6 million customers. The group has successfully eliminated reliance on Russian gas, substituting it with LNG and Baltic pipe imports. Future technologies like hydrogen and small modular reactors, SMRs, are the next frontier. The Hydrogen Eagle project aims to establish ORLEN as a leader in green hydrogen mobility, while SMRs are planned to provide stable, zero-emission industrial power by the mid-2030s. Capturing the shift toward EVs, ORLEN is rapidly expanding its charging network. By integrating these points into existing retail and logistics hubs, the group is preparing for the eventual decline in traditional liquid fuel demand. Governance at ORLEN is structured around risk management. With an 80% independent board and executive remuneration linked to ESG targets, the group ensures that strategic decisions are aligned with long-term sustainability and shareholder interests. Following new ESRS standards, ORLEN's 2024 disclosures show significant progress. 15% of capital expenditure is now fully aligned with the EU taxonomy, reflecting a tangible commitment to the environmental and social transition. In conclusion, ORLEN is undergoing a pragmatic transformation. By leveraging its strong cash flows from legacy assets to fund a diversified green energy portfolio, the group is well positioned for the 2026 milestones and beyond. The strategy balances financial discipline with regional energy security. Thank you for your attention. For a deeper dive into this market research or for customized reports, please contact us at HDIN Research. Our contact details are provided here. We look forward to your inquiries.